navigating the financial markets, it can really feel like you're trying to tune into a weak radio signal, lots of static.
Definitely. Prices jump around, dip.
Yeah,
It's really hard to tell what's real movement and what's just background noise.
exactly. And cutting through that noise to find the actual trend, well, it's pretty essential if you want to make any sense of it all.
It really is. Without some way to smooth things out, you're just bouncing off every little flicker.
And you, our listener, you've actually sent us a great collection of sources about one specific tool designed for exactly this, the Exponential Moving Average, or EMA.
It's a really popular one. It takes that kind of choppy price data and smooths it out into a clearer line, helps spot the trend.
And the key thing, based on these sources, seems to be that it reacts faster to recent price changes than, say, the simple moving average.
That's its defining feature, yeah. That faster reaction time compared to its cousin, the SMA.
Okay, so our mission here today is to really unpack the EMA. Want to dig into its history, which is surprisingly varied.
It really is.
How it actually works under the hood, what people use it for, its strengths, its weaknesses.
And crucially, how you might be able to understand it and maybe use it effectively. It's more than just seeing a line on a chart.
Right, it's about understanding the why behind it. Okay, so let's unpack this. Where did this thing even come from?
Well, okay, so moving averages themselves, for smoothing financial data, they go way back, early 20th century.
Right.
But the specific technique for the EMA, the exponential smoothing part, that actually started completely outside of finance.
Oh, really? Where?
It was introduced by Robert Goodell Brown back in '56, and he wasn't looking at stocks at all. He was focused on industrial operations.
Huh. Like factories.
Yeah, basically forecasting inventory demand. Imagine trying to predict how many widgets you need to make next month based on past sales.
Okay, inventory forecasting.
Yeah.
So the idea was maybe recent sales are a better clue for next month's demand than sales from 6 months ago.
Exactly. That's the core idea. Recent data is probably more relevant for what's happening now or very soon. That
Yeah.
drove it.
Makes sense.
And others built on it. Charles Holt added a trend piece in '57. Peter Winters added seasonality in '60, leading to the Holt-Winters methods, which are, more complex forecasting tools.
Wow, so it's got roots deep in statistics, operations research, not just trading. That's pretty cool.
Absolutely. Even quality control. S.W. Roberts introduced something called the EWMA control chart in '59. Though, interestingly, your sources point out that the quality control field didn't really jump on it right away, despite the theory being sound.
So it kind of bounced around different fields before it properly landed in trading.
Seems that way, yeah. The math was there, but sources suggest people like Ed Sikoda were really key in popularizing it among traders. So while the math's older, he might be the one who really got it adopted widely in finance.
That's fascinating.
It really shows how a technique built for one problem, like managing warehouse stock, can become a fundamental tool somewhere totally different, like analyzing market prices.
Yeah, that cross-pollination is always interesting. So once it did land in the financial markets, what became its main job, its popular uses?
Okay, so the primary goal, like your sources make really clear, is smoothing out those short-term price jumps and dips to show the underlying trend of direction more clearly.
Right, filtering the noise.
And because it weights recent prices more heavily, it just naturally reacts faster to shifts in market mood compared to a simple moving average. That speed is what traders often want, identifying potential trend changes quicker.
So job one is seeing the trend and maybe getting an early heads up if it's changing.
Yes. A rising EMA suggests an uptrend. A falling one suggests a downtrend. Even the steepness of the line can give you a visual cue about how strong that trend might be.
And then people use it to actually generate trade signals. How does that work?
There are a few standard ways. One simple way is just looking at where the price is relative to the EMA line itself.
Okay.
A common signal is buy when the price crosses above the EMA, sell when it crosses below. Your sources mention this is a pretty straightforward approach.
Price crossing the line. Got it. What about using more than one EMA? I see that all the time on charts.
Oh yeah, that's the EMA crossover strategy. Very popular. You plot two, sometimes more, EMAs with different lengths, different end periods.
Like a short one and a long one.
Exactly. Say a 12-period EMA and a 26-period, or maybe a 50 and a 200 for longer-term views.
Okay.
A buy signal happens when the shorter, faster EMA crosses above the longer, slower one. For that 50-200 pair, that specific bullish crossover is often called the golden cross.
Ah, I've heard of that.
And the opposite, when the shorter EMA crosses below the longer one, that's your sell signal. For the 5200, that's the death cross.
Golden cross, death cross. Okay.
The idea is that this crossover gives you a bit more confirmation of a potential trend shift than just the price crossing a single line.
So the short EMA is like the scout running ahead, and the longer one is like the main army confirming the direction.
That's a great way to put it, yeah. And EMAs are also used quite a bit to identify dynamic support and resistance levels.
Dynamic, meaning they move with the price.
Exactly. In an uptrend, a rising EMA line can often act like a moving floor where prices tend to find support and bounce. In a downtrend, a falling EMA can act like a moving ceiling, providing resistance.
Okay. It does seem pretty flexible.
It is, very. And beyond direct trading signals, sometimes it's just used to kind of clean up the data before feeding it into more complex models.
Like a pre-processing step.
Right. And, importantly, the EMA itself is actually a building block for other really widely used indicators. The most famous one is probably MACD, the moving average convergence divergence.
Okay, so MACD actually uses EMAs in its calculation that connects some dots.
It does.
And these sources say it's used pretty much everywhere. Stocks, Forex, crypto.
Yeah, basically any asset that has price data over time can have an EMA applied to it. That
Yeah.
versatility is a big part of why it's so popular.
Makes sense.
And like we saw with its origins, it pops up outside finance too. General short-term forecasting in economics, supply chains, even sometimes as a baseline to see if more complex models are actually doing any better.
Okay, let's get into the weeds a bit. How does it actually work? What's the calculation?
Okay, so at its core, the EMA is a type of weighted moving average. The big difference from a simple moving average, or SMA, is how it weights the data.
Right, the weighting is key.
Instead of giving every price point in the look-back period the same importance, like SMA does, the EMA applies an exponentially decreasing weight to older data points.
Exponentially decreasing, meaning the newest price matters most, yesterday's matters less, the day before even left, and it drops off fast.
Precisely. The most recent price gets the highest weight, and the influence of older prices just fades away exponentially.
Okay, and the formula.
The core formula is what we call recursive. It looks like this. EMA current equal price current K plus EMA previous 1K.
Okay, hold on. Current EMA equals current price times K. Previous EMA times 1 minus K. And K is?
K is the smoothing constant. We'll get to how K is set in a sec, but that recursive part is important.
Recursive means it uses its own previous result.
Exactly. To calculate today's EMA, you need yesterday's EMA result, and yesterday's needed the day before's, and so on. And because of that structure, here's the cool part. Today's EMA value actually contains, implicitly, information from all the past data points in the series, not just the last end days.
Whoa, okay. So unlike an SMA where old data just falls off the cliff once it's outside the window,
Right.
with an EMA, data from way back still has some tiny, tiny influence just fading out.
That's it, exactly. It never completely forgets. It just heavily prioritizes what just happened.
Okay, that feels like a really fundamental difference. Now that smoothing constant, K, how do you figure that out?
K is directly tied to the number of periods N that you choose for your EMA. The standard formula is K equals 2, N plus 1.
K equals 2 divided by N plus 1.
Correct. So you can see if you pick a small N, like a 10-period EMA.
Then N plus 1 is 11, so K is 2/11th, which is around 0.18.
Right, about 18%. Now if you pick a big N, like a 50-period EMA.
N plus 1 is 51. 2 divided by 51 is much smaller, like under 0.04.
Yeah, around 3.9%. So a smaller N gives a bigger K. A bigger K means more weight goes to the current price in that formula, price current K.
Making it react faster.
Exactly. And a larger N gives a smaller K, meaning less weight on the current price, more on the previous EMA, making it smoother and slower.
That makes the tuning aspect really clear. But hang on. If the formula needs the previous EMA, how do you calculate the very first one? There's no previous when you start.
Excellent question. You need a starting point, right? An initial value.
Yeah.
The standard way is this. For the very first EMA calculation, you actually just use the simple moving average SMA of the first N periods.
So you calculate a regular SMA for the first, say, 10 days.
If N is 10, yes.
And that SMA value becomes your EMA value for day 10. And then you start using the recursive EMA formula from day 11 onwards.
That's exactly it. You kickstart it with an SMA for the initial N periods, and then the recursive formula takes over. The sources lay this out very clearly.
Okay. Understanding that recursive nature in the SMA start really clarifies things. So what assumptions are baked into this? When does using an EMA make the most sense?
Well, the most fundamental assumption built right into that exponential weighting is that recent price data is simply more relevant for figuring out where prices might go next than older data is.
Which feels pretty intuitive, right?
Yeah.
Especially in fast markets. What happened 10 minutes ago feels more important than last week.
Right. And while it's not like a mathematical assumption of the formula, using EMA-based trading strategies usually implies you believe that trends tend to persist for a while. You're using the line to help you catch and ride those trends.
And it's based on the general technical analysis idea that markets aren't totally random, that human behavior creates patterns that might repeat.
Precisely. Now, as for the conditions where EMA tends to work best,
I'm guessing number one is the market actually needs to be trending.
yes, that's the big one. Your sources really hammer this home. EMA is most effective in markets that are clearly moving up or down.
Not sideways.
Definitely not sideways. In ranging, choppy, non-trending markets, that very sensitivity that helps in a trend becomes a major drawback. It starts generating tons of false signals.
The whipsaw.
Exactly, the whipsaws. Price chops back and forth across the EMA, signaling trend changes that just aren't real.
So EMA loves a smooth trend but gets seasick in choppy waters. Got it.
Yeah.
What else?
You need good data. Sequential, regular time series data. The prices need to be in order, and the time between them consistent daily, hourly, 15-minute, whatever.
Because the end period only makes sense if each period is the same length of time.
Right. If you have big gaps or weird intervals, the calculation gets messy and potentially misleading.
Makes sense.
And you need enough history, at least end periods, just to calculate that initial SMA to get started.
And as we saw, picking the right end seems absolutely crucial.
It's the single most important dial you have to tune. How well an EMA strategy works really hinges on picking an end that fits your trading style, your time frame, and the specific thing you're analyzing.
Understanding these conditions is key. Tells you when EMA is likely to be helpful, and maybe more importantly, when to be really careful with it. So how do you actually do it? Step by step.
It's pretty logical once you get the math. Step 1, choose your N, the look-back period length. That's your main decision based on your goals.
Pick and check.
Step 2, get the historical price data for your asset, usually closing prices, make sure it's sorted chronologically, and you have at least the last N data points.
Get the data. Check.
Step 3, calculate the simple moving average, SMA, for just those first N data points. That result is your very first EMA value, the starting point.
The SMA kickoff. Check.
Step 4, calculate your smoothing constant, K, using that formula, K equals 2N plus 1. Once you've picked N, K is fixed.
Calculate K check.
Okay, step 5, the main loop. You go through the rest of your price data, starting from price point N plus 1. For each new price, you apply the main recursive formula, EMA current price K plus EMA previous, 1K. You use the current price, your fixed K, and the EMA value you just calculated for the previous period.
And you just repeat that calculation for every new price point, building the EMA line over time.
That's the essence of it. You calculate today's EMA using today's price and yesterday's EMA result. Then tomorrow, you use tomorrow's price and today's result. It just rolls forward.
Okay. Initial SMA, then just keep applying the formula, feeding the last result back in.
Exactly. Your sources even have some descriptions, maybe even code snippets, showing that loop. Get price, get previous EMA, calculate current EMA, store it, repeat. It helps visualize how the math turns into something practical.
Yeah, that's useful for anyone coding it up or just understanding charting software better. Speaking of data and parameters, what are the really critical things about the input data, and how do you actually refine or tune that main parameter? N.
Okay, data requirements. Main thing is that time series of prices, usually closing prices. It has to be sequential, and the time intervals need to be consistent.
Daily means daily, hourly means hourly. No weird gaps or changing intervals.
Right, because N only means, say, 10 days if each period is a day. If the time between points jumps around, a 10-period EMA loses its meaning.
Got it.
And you need enough history, at least N periods, for that initial SMA. Critically, data quality. Garbage in, garbage out is definitely true here.
Why especially for EMA?
Because it weights recent data so heavily. A glitch, an error, a missing value in the most recent data point will have a much bigger, more immediate impact on your EMA line than it would on an SMA, where the error's influence gets averaged out over the whole window.
Ah, okay. So clean, consistently timed data is vital, and the tuning all revolves around N, the period length.
Pretty much, yeah. N is your main control knob. A short N, like 5, 10, 20 periods, makes the EMA really sensitive. It hugs the price action closely, reacts super fast.
Good for catching quick moves.
Yeah, if you're aiming for short-term trades, but, and this is the trade-off, it dramatically increases the risk of those false signals, the whipsaws, especially when the market isn't trending strongly.
Right. More speed, but more likely to get faked out by noise.
Precisely. Now, a longer N, think 50, 100, 200 periods, makes the EMA much smoother. It filters out a lot more of that short-term chop.
Better for seeing the bigger picture, the longer trends.
Exactly. It's better for identifying and riding those longer-term moves. But the trade-off here is lag. It will be slower to tell you when a major trend change might be happening.
So longer in, smoother, lags more, better for the slow grind, but you'll be later to the party getting in and out. It's a direct trade-off.
Absolutely. And picking N shouldn't be random. It really needs to be tied to your trading style and the time frame you're looking at.
How so?
Well, a scalper trading on a 1-minute chart might use a super short EMA, maybe 5 periods, to react instantly. A day trader on hourly charts might use a 12, 20, or 26. A swing trader holding for days or weeks, maybe a 50 period on a daily chart.
And long-term investors.
They'd likely be looking at 100 or 200 period EMAs, probably on daily or even weekly charts, to see the major trends.
So the right N is totally context dependent. How fast you trade, what chart you use.
Yes. And even market volatility can influence it. Very high volatility might whipsaw shorter EMAs more, maybe suggesting a longer N could be more stable. The sources actually have a helpful table summarizing these common periods and their typical uses.
Oh, that's handy. A good starting point.
Definitely. And a key part of tuning isn't just picking one N. Often it's about backtesting different EMAs or combinations like those crossover strategies.
Testing pairs like 1226 or 5200.
Right, or even triples like 5921. You run them on historical data for the specific asset you care about. You see which combination worked best in the past for that asset under those conditions.
So no magic numbers. You have to test and see what fits your specific situation.
Exactly. It takes experimentation. Which leads to the next question. How do you even know if an EMA strategy is working well? How do you measure performance?
Good question.
Well, if you're just using it for general smoothing outside of trading, you might look at standard statistical errors like mean squared error to see how close the line fits the data.
Okay, measuring the fit.
But for trading, which is where most people use it, performance is really about profit and risk. The most basic measure is just profit or loss, right? Did it make money?
Did it beat just buying and holding the thing?
That's a key benchmark. Comparing against buy and hold is standard. You'd also calculate things like the compound annual growth rate, CSGR, to see the yearly return.
Right. And your sources mentioned some studies on this.
Yeah, some interesting ones. One looked at EMA crossovers on Indian Nifty 50 stocks and found they actually beat buy and hold in, I think it was 61% of the cases they tested over a specific period.
Over half.
Another study focused on Bitcoin reported a pretty huge profit, like 394% from an EMA strategy. And even studies looking at less, say, mainstream markets, like the Iraq Stock Exchange using SMA or some BRICS markets, suggested moving average strategies could potentially outperform just holding, even after costs.
Those numbers sound pretty good, so the studies suggest it can work.
They definitely suggest potential profitability in specific markets during specific times. People often point to these as evidence that maybe technical tools like EMA can exploit some market patterns or inefficiencies.
Are these studies the whole story? There's always the risk of curve fitting, right? Picking the parameters that just happen to work perfectly on past data. How reliable is that?
That's a really critical point. And while the sources highlight these positive findings, they also, implicitly at least, warn that past performance is absolutely not a guarantee of future results.
Right.
Profitability depends hugely on the parameters chosen, the asset, the time frame, and crucially, the market conditions during that test period. A strategy that killed it in a raging bull market might fall apart completely in a choppy sideways market.
And the sources mention counterexamples too.
Yes, and that's just as important. They mention a specific backtest on Apple stock using an SMA crossover, I believe, that actually lost money over its test period.
Ah, okay, so is that a one-way street?
Not at all. That Apple example is vital. It shows that just applying these things without careful thought and testing can easily lead to losses. And the fact that people are still backtesting ideas like EMA crossovers on newer stocks like Tesla shows it's an ongoing validation process, not a solved equation.
Okay, so Potential exists, according to some data, but it's definitely not guaranteed, and rigorous testing seems essential.
Yeah.
What other metrics matter besides just profit?
Beyond profit, you look at the win rate, what percentage of trades were winners. Risk-adjusted returns are crucial. Things like the Sharpe ratio.
Which measures return versus risk, basically.
Exactly. Return per unit of risk taken, a higher Sharpe is better, and maximum drawdown is a big one. That tells you the biggest percentage drop your account experienced from a peak, shows you the potential worst-case pain.
Gives you a much better picture than just the final profit number. And what about speed? You mentioned EMA is faster. How's that measured?
We often talk about that as latency or lag. EMA has lower latency, less lag than SMA because it turns faster when prices change. It's not about computer speed, it's about how quickly the signal adapts to new price action.
How timely the signal is.
Yes. And accuracy, in this context, usually refers to how reliable the buy-sell signals are in actually leading to profitable trades. That's kind of indirectly measured by all those profit and risk metrics we talked about.
Okay, so EMA can potentially work, but it's complex, needs validation. How does it stack up against other common tools, like SMA, which we keep mentioning?
Right, let's compare. SMA, simple moving average. The key difference again, weighting. SMA gives equal weight to every single price point within its look-back period, N.
So day 1 matters just as much as day 10 in a 10-period SMA.
Correct. EMA gives that exponentially decreasing weight. Day 10 matters way, way more than day 1 in a 10-period EMA.
Which makes EMA faster and more responsive.
Significantly faster to react to recent changes. SMA, because it averages everything equally, is inherently slower. It lags more.
Slower and lags more. Is that always bad, though?
Not necessarily. Because SMA is slower, it's also generally smoother. It filters out more short-term noise than an EMA does, especially if you use a longer period. In really choppy, messy markets, that extra sensitivity of the EMA makes it much more prone to those whipsaws, those false signals, than a slower, smoother SMA would be.
So EMA often preferred for shorter-term trading where speed matters. SMA might be better for very long-term views or if you really want to smooth things out.
That's a good summary, yeah. M&A trades some smoothness for speed. SMA trades speed for smoothness.
Okay, what about WMA, weighted moving average?
WMA, right. Like EMA, it also gives more weight to recent data, but WMA uses a linear weighting.
Linear.
Meaning the most recent price gets the highest weight, the next most recent gets the second highest, and so on, decreasing in a straight line down to the oldest price in the period. EMA uses that exponential curve.
So WMA is also weighted towards recent data, just a different formula than EMA.
Yes. EMA is often considered maybe a tiny bit faster or more responsive to the very latest price than WMA, but they're both much faster than SMA. Some people see WMA as a kind of middle ground, but EMA is probably more common, partly because of its connection to that exponential smoothing concept. Often just comes down to testing and preference.
Okay. And MACD, we said EMA is used in MACD. How are they different in practice?
MACD is fundamentally different. It's not just a smoothing line on the price chart. It's a momentum indicator.
Momentum, okay.
It's derived from the relationship between two EMAs, typically a 12-period and a 26-period. The main MACD line itself is simply the difference between those two EMAs.
The gap between the fast and slow EMA.
Exactly. And then MACD usually has a signal line, which is often a 9-period EMA of the MACD line itself, and a histogram showing the difference between the MACD and its signal line.
Wow. Okay, so it's analyzing the interaction and the momentum shown by the EMAs, not just the price smoothing.
Precisely. Basic EMA signals are like price crossing the line or two lines crossing. MACD signals come from the MACD line crossing its signal line or crossing the zero line. And importantly, from divergences between MACD and the price itself.
Divergences can signal weakening momentum, right?
Yes, potentially warning of a trend change even before the price or EMAs fully turn. So MACD adds that layer of momentum analysis on top of the trend-following nature of the EMAs it's built from.
That comparison table in the sources is really helpful here. It lays out the weighting, the speed, the lag, what each is good for. Makes clear there's no single best tool. They have different jobs, or you use them together.
Absolutely. Understanding their strengths and weaknesses is key to knowing when and how to use them.
Okay, let's recap those then. EMA's main advantages.
Biggest strength, responsiveness. That exponential weighting makes it react faster to recent price shifts than SMA. So potentially quicker signals, less lag spotting trend changes.
Timeliness. Crucial for traders.
Yes. It's pretty good at helping identify and confirm the trend direction. The slope gives a visual sense of strength, and it often works well as dynamic support or resistance. Plus, fundamentally, it does smooth the data, filtering some noise.
And it's flexible, right, tuning in.
Exactly. Highly customizable for different assets, time frames, styles, and as we said, it's a building block for other important indicators like MESCD.
Those are solid points. What about the downsides, the weaknesses?
The biggest one, despite being faster than SMA, is it's still a lagging indicator. It's based on past prices.
It confirms, doesn't predict.
Right. It tells you what the trend was or is just now changing to, not what it will be. It's always going to be a bit late calling the exact tops and bottoms.
Okay, the lag is inherent.
And that responsiveness, its main strength, becomes its biggest weakness in sideways or choppy markets. That's where you get slammed with false signals, the whipsaws. Price just bounces around the line, signaling changes that don't stick.
Its sensitivity makes it follow signals well, but also makes it follow noise just as well.
Perfectly put. That's the core trade-off your sources highlight. Responsiveness is tied directly to false signals in non-trending conditions.
Anything else?
While that heavy weight on recent data can sometimes be a negative if the very latest price was some weird spike or outlier that doesn't reflect the real market, older, maybe more significant price levels lose influence very quickly.
A strong recency bias built right in.
Yes. And like all technical tools, its whole premise is questioned by the efficient market hypothesis folks, who argue past prices can't predict the future anyway. It can also get thrown off by big price gaps overnight or on weekends because that new opening price gets such high weight immediately.
Okay, so a powerful lens, but you need to be really aware of its blind spots, especially the choppiness issue. Can you give some practical examples? Where does it work well? Where does it fail based on the sources?
Sure, based on the material, EMA really shines when markets are in clear, sustained trends, up or down.
Smooth sailing.
Yeah. When price is moving steadily, the EMA follows nicely, shows clear direction, often provides good dynamic support resistance bounces. It's also good for confirming breakouts when price decisively breaks above or below a consolidation range where the EMA was flat.
Strong trends. EMA's happy place. Where does it really struggle?
Sideways markets, ranging markets, choppy markets. When price is just bouncing between levels without going anywhere, the EMA line gets sliced up constantly. Crossovers happen back and forth, generating signal after signal that goes nowhere.
The whipsaw nightmare.
Exactly. It's a direct result of the EMA doing its job reacting to price changes, but in that environment, the changes are mostly noise, not real directional moves.
It's just efficiently tracking the randomness.
Pretty much. Markets with high volatility but no clear trend are also tough. And if trends are super short-lived and reverse quickly, the lag might mean you get a signal just as the move is already over.
This whole trending versus non-trending thing feels critical. It almost suggests you need another tool first, just to figure out if the market is even suitable for EMA signals right now.
That's a very sharp insight, and yeah, the sources definitely imply that. A more robust approach might involve using some kind of trend filter,
Like what?
maybe another indicator like ADX, or just looking at the price action on a much higher time frame. First, you try to determine, is this market actually trending? Then, if yes, you start paying attention to the EMA signals on your trading time frame. It helps avoid using the tool precisely when it's most likely to fail.
That makes a ton of sense. Use it as part of a system, not the whole system.
Yeah.
Okay, let's talk specific applications. Any case studies mentioned?
Yeah, in finance, it's everywhere. Sources talk about analyzing stocks like Apple, maybe using a 21-day EMA for shorter trends, a 100-day for longer ones. Crossover strategies are common. That 12-day crossing the 26-day EMA is mentioned for things like E-mini S&P futures. It's a classic setup, partly because it feeds into MACD.
And widely used in Forex too, right?
Oh yeah, huge in Forex. Common pairs might be 10 and 20 EMAs, or the 50 and 200 on major currency pairs like euro-dollar. Different traders pick different periods depending on how they trade.
That crossover seems really popular. What are some common combinations people might start with?
Well, the 1226 EMA crossover is almost iconic, again, because of MACD. The 5200 crossover is probably the most famous, defining that long-term golden cross for bulls and death cross for bears that you hear about in the news.
Right.
But you see others too, very short ones, like 5 and 8 EMA for really quick signals, maybe sets like 9, 13, and 50 for swing trading, or even 5, 9, and 21 for super short-term scalping.
Gives people concrete numbers to start exploring. And outside of finance.
Well, back to the start, Robert Goodell Brown used it for inventory forecasting, but more generally, that exponential smoothing technique can be used on almost any sequential data series. Economics, weather patterns, engineering data, anywhere you want to smooth out noise and see an underlying trend.
So the core math is broadly useful. What about the results from those studies again? Did they give specific numbers on assets?
They did, yeah, though always with the caveat that it's past data. The Nifty 50 stock study in India found EMA crossovers had a higher key jur than buy and hold in 61% of the stocks tested over their specific period, which included the COVID crash and recovery.
Interesting. And during just the COVID period itself?
EMA apparently beat buy and hold in 12 out of the 13 stocks.
Wow. That's quite strong during a wild time.
The Bitcoin study claimed that 394% profit rate over its test period using an EMA strategy. And those studies on places like the Iraq Stock Exchange or BRICS markets also suggested moving averages could potentially generate better returns than just holding, even with costs factored in.
Those positive results definitely catch the eye.
They do. But again, you need the counterexamples. That mention of the Apple SMA backtest resulting in a loss is the reality check. It proves these aren't magic money machines.
Context and tuning matter hugely.
Absolutely.
But
Success depends on parameters, asset, time frame, market conditions. And the fact that people are still testing, like that idea for a 1326 EMA on Tesla, shows it's an ongoing search for what works now, not a settled science.
Okay, so potential shown, but demands careful work. Given all this, what are the key recommendations for someone actually wanting to use EMA effectively? And what's next for research?
Right. Recommendations. Number one, absolutely critical. Selecting the right period N. This is not one size fits all.
Makes testing.
It requires careful back testing on the specific asset and time frame you're trading. Use historical data. Measure performance using profit, sure, but also Sharpe ratio, drawdown. Get the full picture.
Then make sure N fits your style.
Yes. Align N with how you trade. Short N for fast, quick trades. Longer N for identifying slower, bigger trends. Consider the asset's volatility too. Don't just grab a number you saw online.
Test for your specific situation. Got it.
Next big one. Don't use EMA in isolation.
All right.
Seriously.
Right.
Combine it with other indicators
Right.
to confirm signals and, crucially, to filter out those false ones, especially in choppy markets. Popular partners are things like RSI, the Relative Strength Index, to check momentum and overbought, oversold levels. MBD, obviously, for momentum confirmation. Bollinger Bands can help assess volatility and see if price is getting stretched. And volume analysis, does volume confirm the price move across the EMA?
Layering confluence, adding evidence. Makes sense.
Right. Consider using multiple EMAs together, like those dual or triple crossovers, and again, fine-tune those periods based on testing. And a more advanced idea we touched on, market regime filtering.
Trying to figure out if it's trending or sideways first.
Exactly. Try to identify the market state before acting on EMA signals. Only use the EMA strategy if you think a trend is actually in place. This tackles the whipsaw problem head-on.
Smart. Only use the tool when the conditions are right for it.
Precisely. And non-negotiable for any trading. Strict risk management. Always use stop losses.
Protect your capital.
Absolutely. Maybe place stops relative to the EMA itself or other support resistance. Decide your position size based on how much you're willing to risk per trade. Evaluate the potential reward versus that risk.
Risk management underpins everything.
Yes. And finally, remember, markets change. What worked last year might not work next year. Regularly review how your EMA strategy is doing. Be willing to tweak parameters or even change your whole approach if the market shifts.
So continuous learning, adapting, combining tools, managing risk.
Yeah.
That seems to be the path. What about the future? What's being researched with EMAs?
Well, there's a lot of interest in developing adaptive EMA.
Adaptive.
Yeah, versions where the period N isn't fixed, but automatically adjusts based on things like current market volatility or trend strength. The goal is to make it more robust across different market conditions without manual rekeying.
An EMA that tunes itself. That sounds cool.
Could be. There's also work integrating EMA signals as inputs for machine learning models. Maybe AI can find more complex patterns using EMA data than simple rules can.
Using EMA as fuel for AI trading.
Kind of, yeah. More research is also needed just to rigorously optimize EMA strategies for newer things like crypto, which behave differently, and really drilling down on profitability after all the real-world costs, commissions, slippage, etc., especially for fast strategies.
Accounting for the friction.
Right. And maybe more behavioral finance work. Why do simple rules like EMA crossovers sometimes seem to work? Is it tapping into psychology, herd behavior? And just exploring EMA's role within bigger multi-factor quantitative models, seeing it as one piece of evidence, not the whole puzzle.
Shows that even an old tool like EMA isn't necessarily solved. Still room to innovate.
Absolutely. Understanding markets is a never-ending process.
So wrapping this all up, What does this mean for you, our listener?
It means the EMA, the Exponential Moving Average, it's definitely a valuable tool. It's popular for a reason, great for smoothing price, helping spot trends. Its key advantage over the SMA is that faster reaction time, weighting recent data more.
But that speed is a double-edged sword.
Exactly. That responsiveness is also its main weakness. It makes it prone to false signals, those whipsaws, when the market isn't trending clearly, when it's choppy or sideways. And remember, it lags, it confirms trends, it doesn't predict them.
So you absolutely cannot just use it on its own.
Critically, no. Its power comes from how you use it. That means diligently testing and choosing the right N for your specific situation, understanding the market context, trending or not, combining it with other tools for confirmation, using strict risk management like stop losses, and constantly evaluating and adapting.
The studies show potential profit, but the counterexamples show potential pain if you misuse it.
Right. The Nifty 50 or Bitcoin studies are intriguing, but that Apple loss example is the reminder. Context and careful application are everything. It has roots outside finance, and it might evolve further with adaptive tech or AI.
It's a powerful piece, but just one piece of a larger analytical approach.
Precisely, a key part of a well-rounded toolkit.
Which leaves us with a final thought to chew on. Given that EMA is built entirely on the idea that recent prices matter most, how much does its effectiveness really depend? Not just on the calculation itself, but on your ability to accurately judge whether the market right now is actually in a state where trends are likely to stick. Or is it just noise?
That's really the crux of it, isn't it? Is the market playing the game EMA is designed for?
Or, flip side, considering some studies do show potential profitability, what does that suggest about markets themselves? Maybe they aren't perfectly random or efficient. Maybe human behavior creates patterns, predictable enough at times, that even a relatively simple tool like EMA can sometimes exploit.
The fact that these trend-following tools can show positive results in some tests definitely makes you wonder about market efficiency and psychology. It's something to ponder next time you see that EMA line tracking the price.